Hi, everyone, and welcome to this episode of Ask T3. I'm your host, Nick Bailey, Chief Real Estate Officer at T360. And today we've got another hot topic for you. Valuations, what's your brokerage worth? And M&A activity, what's happening with mergers and acquisitions? And we have one of the most knowledgeable people in the real estate space to help talk about it today. So thanks for joining us, whether you're live on LinkedIn, YouTube, or Facebook. We want you to be part of the conversation or bring us an idea. Always visit us at askt3.com and share a comment, share a show idea, and keep the conversation going. So let's jump right into valuations and welcome our guest today, Mr. Fran Santangelo. Fran, thanks for joining us.
Hey, Nick, thanks for having me. It's great to be here.
Okay, so hot topic going on, valuations. We work together, you work independently, you're a wealth of knowledge. We're seeing valuation requests and M&A activity, more things happening, but give us your idea of the landscape of what you're seeing right now.
Yeah, absolutely. So we've been working with T360 now for about a year, just coming on a year in the valuations and the transaction department. Before that, I've been working in an independent capacity since 2018, working with companies in the same space, valuations and mergers and acquisitions. And right now you're seeing a lot of activity in valuations because people want to know, like you said, what's their company worth, and more so, how do they position themselves for sale? The valuation process is not necessarily about the end result, which is giving a number to the particular client to say your company is worth X or Y, but the valuation process is incredibly helpful to brokerages because it positions themselves and it prepares them for a potential transaction. And that could be a transaction where they're giving stock or equity to a manager or to family members or positioning themselves to market their company to the public or to the industry. So the process, I think, is as much a part of really the value of the valuation engagement that we do at T360 as anything.
So when we talk valuations, for several years, I've done a lot of work in this, being around brokerages as well, not doing the valuations, but being part of some of these transactions. Some of these brokerages, their back office, is it accurate to say almost a complete disaster? Like it's like taking a shoebox full of receipts to your accountant at the end of the year. Like, tell us what you see and recommendations on if you're thinking about whether it's getting a value, if you're selling, if you're looking at using a valuation to be a buyer, how should you have back of the house set up to make this process really efficient and the most accurate it can be?
Yeah, that's a great question. So years ago, people were using shoeboxes and Excel spreadsheets, and there have been a lot of great companies that have come along in that space, to help out, the back office function and to work with the QuickBooks of the world and those types of things. So it's great. It's great, first of all, to have a back office software, and there's a number of them out there. I don't want to name any in particular because I don't want to overstep, but they're out there and they're great in helping the back office staff organize themselves and make sure that the transactions are being reported correctly. The advice is, if you don't have a competent accountant or controller, get one, because they are invaluable to a real estate company, not only from an ongoing transactional and operational perspective, but if you have any desire to sell your company that is going to, or enter into a transaction, that's going to be incredibly valuable to you. The other is, if you don't have a competent tax advisor, which I know most companies do have, but if you don't have one of those, I would also invest in one and make sure that you've got the best possible tax advisor working with you. Just as an example, I'll give you a great example that we did a transaction a couple of years ago, and the company had been set up in a way as a C Corp. And C Corps are bad because C Corps create double taxation. So when we did the deal, the owners, advised us that there was a C corp, and they hadn't really thought about selling the company. And the issue is that there was going to be double taxation on the consideration of the deal. So when it went to the company, it'd be taxed once, and then it went to the owners, it'd be taxed again. That is not a good outcome. So we had to come up with some creative solutions as to how to get the consideration of the deal to the owners without going through the company. But that could have been avoided if the company had maybe a better, more forward-looking tax advisor giving them advice about positioning the company for sale. So these types of things, when you get involved in the valuation process, just giving them these bits of information, whether or not they're working in a shoebox or they're working with one of the most sophisticated transaction software, back office software, I think it all helps, because the eyeballs that we bring to bear on these individual companies, give them a fresh perspective, and it gives them a little bit more insight as to what their books and records should look like. I'll give you one other example, Nick, is that we dealt with one of our T360 clients, and this happens all the time. They changed accountants. Now, that's not a bad thing, because I'm telling you to get a good one, so you're going to have to change one. The issue is that chart of accounts are what is shown in a profit and loss statement, and if your charts of accounts change, it's very difficult for a third party, a buyer or an advisor of a buyer, to look at that and say, how has rent changed from year to year? They're looking at a couple of years, a couple of periods. If you're moving those reported income or expenses, if you're moving them around, very, very difficult to look comparatively at one year to the next. So you always want to make sure that your charts of accounts are consistent across the years. And again, people that are, in the accounting world, they think that they have their own better way of doing things. And sometimes they do. But if you have a very disjointed periods from one to the next, it could get very, very complicated for a buyer to make a proper valuation, and for us to make a proper valuation. So those are a couple of
and those make sense. But here's what I heard you say about that. Obviously, have good help, but here's what I have a phrase: don't FISBO your business, because it's so interesting. And I think you see this too. And I want to talk about some specific trends and numbers here in a moment. But as a 29-year veteran with a real estate license, we've all seen this if you've ever sold real estate. You go in and the seller always thinks their house is worth more than the comp that you are delivering to them, because their granite's better, because they raised their kids here. And it takes an independent, quote, valuation, appraisal, CMA, to get realistic. How often, two-part question, how often do you see business owners, when they see their valuation, respond almost the same way that a crazy home seller says, yeah, wait, I know that's what the numbers say, but mine's worth way more because it's an emotional response, not a business response? That's question one. And then the number one question I keep getting asked is, what's the current multiple out there? What's the valuation method based on EBITDA in this market? What are most buyers paying? So you go first, and then I'll kind of tell you what I'm hearing about it.
Yeah, sure. So you do get some clients who have a different opinion, or a warped opinion, if you want to call it that, or a pessimistic opinion about what their company is worth. But you find that a lot of people, a lot of clients, they really haven't given it much thought. I mean, they hear the rumors about what companies are worth or how to come to a particular number. It's not the same as, let me look at, my neighbor next door has a very similar house. It's 4 bedrooms, it's 4 baths. I can look at that and say, that's what my house is worth, because it's kind of the same. In real estate, you don't have that. And the funny thing about values in real estate is that, CMAs are great for real estate, and they will show you a particular range of value. But think about the buyer who wants to put their kid in that particular school, or is moving there because they have a particular reason, a family member, or someone that they want to be near, or they want a particular amenity that you have that other houses don't have. that's more akin to what a real estate transaction is like, because you could look at a value and say your value is X, but the market is going to really dictate what your particular value is, because buyers of real estate companies can bring reduction of expenses to bear on a particular business, where buyers of real estate can't really, you don't show up with a solar system and say, I'm going to lower my electric bill because I have this already built into my world. When you do a real estate transaction, there could be a buyer who has staff that's going to be redundant. It could have back office systems that could be redundant. There could be offices that can be consolidated. So a particular buyer is going to look at those and be very excited to pay a higher multiple, because they are going to be able to unlock efficiencies and strategically leverage their business with the business that they're buying. So we always think of businesses being traded, and also this is true of real estate. It's a range of value. There's an old saying in Ninja, it's more of a range of value versus just a particular value on a home. So we normally think about ranges of value as 3 to 5 times of adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So, adjusted is the key word, because companies have EBITDA, operating EBITDA or net income, but they normally have expenses that are extraordinary. They have expenses that are non-recurring. They have expenses that their really creative tax advisor has helped them to limit their tax liabilities. So all of these things go into the process of preparing a company for sale, because you want to do the due diligence and say, here, I built out this conference room. That's non-recurring. That does not go into, that goes into EBITDA when you're looking at your tax liability for a particular year. But when you're looking at a company, you're not going to do that every year. So those are things that are going to be peeled out and added back. We use the term add back. And then when you get to the end game, you're going to look at that range of value. We're using, in our valuations, we're using about 3.5 times now, because the market has gotten a little bit less frothy than it was back in the 2001, 2002 timeframe, where companies were very, very flush with cash. So the buyers were flush with cash because of the impact of COVID, and the sellers were also performing very well, obviously because of the impact of COVID and flexible work and things like that. But there also was a desire of the aging brokers to not have to deal with another cycle. And so a lot of those companies sold at a very, very high multiple relative to 2 or 3 years of operating results. So we try to conservatively go with that 3.5 times, although 3 to 5 is a range. And also, I would be remiss to say that a lot of what goes into valuing a company and final purchase price is going to be deal structure. So, every company, sellers of real estate sell their company, and whether it's financed by a mortgage company, they more often than not, they get a check at settlement. They get cash at settlement. It's not so much in the real estate transaction. Most of the time, if not all the time, in the current market, you're going to get upfront money. You're going to get potentially other forms of contingent consideration based upon the company performing over a period of time, and you actually becoming, as a seller, a partner with that buyer and making sure that there's agent retention. So you've got a range.
And so how much cash? What are you seeing out there? Are you seeing 20%, 40%?
25 to 30% is really aggressive buyers are putting more down. Again, as you guarantee the terms in terms of deal structure, taking out that management risk of the buyer, taking out that the risk of the market risk and the real estate going up or down, and we'll talk about the impact of the NAR settlement also on what's happened in valuations. But as you get higher in terms of guaranteed money, that valuation is going to potentially trickle back down to the 3, because the buyer is giving guaranteed money. You can get up into the 5 range and even higher if you as a seller are taking more risk. And that
I would say you either get price or terms, generally not both. So
exactly.
Higher price, longer terms, lower price, more cash. And
exactly,
what are you seeing as the top 1 or 2 ways to structure that earnout, and how long are people doing them? 12 months, 24 months, 36? What should a seller expect that the market's paying on the term right now?
36 is, and there's just so much nuance to this, Nick. 36 is really kind of where I, in terms of on the buyer side or the seller side, when you're dealing with structuring a deal as a buyer, you want a longer term. As a seller, you want a shorter term, obviously. But 3 years seems to be kind of the Goldilocks, effect of it's a good time frame for the seller to maintain engagement, and for the buyer to fully integrate and create efficiencies, and to potentially bring to bear all of the resources that they have. So, the funny thing is that some sellers don't understand that, when they close, whether they're an aging broker who is potentially retiring, or somebody who is in the business, there's a lot of companies that have selling owners who want to return back to just being being an agent. They're now in the trenches with their former agents and now colleagues, and they're selling real estate, but at the same time they have one eye on the what's happening with the business, because they're potentially a partner of the particular of the buyer. And I mentioned the NAR settlement. When we went into August of 2024, and the market and the drumbeat of reduced commissions on the buyer side was getting very, very, very loud, and no one knew what was going to happen. What was interesting is that all the buyers kind of, they started to pull back, because they're like, I don't know what's happening with a particular company. We were talking about, what's the ratio of selling sides to listing sides. Are you a listing broker? Okay, the buyer side commission may not impact you as much. If you're getting all your leads from Zillow and you're a buyer agent, now all of a sudden, are you going to be able to articulate your value proposition to your buyers and still maintain that level of gross commission? And what's funny is that in the last year, because we're almost exactly a year from August 17th, which is kind of funny. We're just on that date. You've seen agents, and we're kind of switching topics a little bit. You've seen agents really dig in and be able to articulate their value on the buyer side. And I have been really very impressed with what real estate companies have done to maintain their buyer side commissions. And I have not seen in any valuation that I've done in the companies that I work with, a lot of slippage. There's some, but Nick, we try to work with the best. The best seek us out at T360, and with our help in terms of coaching and mentoring and consulting, I think that little bit of concern and that hesitation to look at a company and say they can maintain this level of commission, notwithstanding the buyer side issue and vulnerability and compromise that we thought was going to happen. It to me, it really hasn't happened. And that's,
I agree. I think it is returning a brokerage buyer's confidence that there's not going to be overly negative top line revenue impact equating to some type of EBITDA. Let me ask you a couple more questions kind of around this of giving advice. what are one or two things that you would say that you most commonly see that blow up a deal? The biggest mistakes or pitfalls that people make that they can avoid in doing this. And then maybe the second part we'll wrap on it is one or two of things that people make sure to do right to get these deals done.
There's an old saying, time kills all deals. That is the one thing that I think is the biggest impediment to a transaction, is not having a particular seller or buyer, because it happens on both sides, being motivated to do the deal. And that just seems kind of simple, but especially when you're a seller, you call, a seller reaches out and says, hey, I'm interested in marketing my company, doing a valuation. And you're sitting there and you're like, when are they going to get back to us? What's happening? Why? Oh, well, I got busy and I got this and I got family stuff. And everybody has a million things going on, but that, when you put that particular type of delay and hesitancy into a transaction process, that kills the deal. I mean, that is.
So what would be the time frame? What's the magic timeline to get a deal done? When do you think too much time has gone by?
I think, there's pieces of that. Obviously, there's due diligence, there's letters of intent, there's, initial drafting. I think that from start to finish, I think you're talking about, 90 days, maybe a little bit more than that, 90 to 120 days. If you've been able to identify a party that's culturally a fit with your company, if you're a buyer or seller, and you move into that transaction phase, you want time to be able to prepare from the time you're signing a deal to changing the signs and doing all the transition. You want to do it right. So you don't want to rush into the transaction in terms of flipping the company to the new ownership. But when you're in that due diligence phase, when you're in that negotiation phase, in that process, that documentation phase, the failure to return, requests and turnaround requests can be very, very damaging. Can be very damaging because they'll just move on to something else. So I think that's the biggest thing that I've seen over the years in terms of, killing deals. So, and what was the second question? I forgot the second question.
Best advice, if someone wants to do this, they're sitting here saying, I've never done an M&A deal. I've never done a valuation. Should I get it valued before I go to market? How do I kind of tell people that I'm interested in selling my brokerage? Because here's what I always hear. Yeah, I'm maybe interested if someone wanted to buy, but I'm definitely afraid that if wind gets out there on the street, if my agents find out that I even have a thought about selling, everyone's going to evacuate. And so I don't know how to find a prospect without creating an potential unstable environment for the agents that I have. So advice around that?
I think that in the same vein, the compression of the time frame creates less risk that agents are going to find out, the market's going to find out, someone's going to have a couple of glasses of wine at a cocktail party and allude to something. And we live in a small community of real estate professionals nationally, Nick, just like you and I have crossed paths a couple of times. But think about a market, think about a small town or a particular city where people are communicating with each other all the time. That information is going to get out, so that when that process becomes elongated, it becomes very, very risky. So what my thought on your question is that if you go through the valuation process and you're preparing your books and records and you're getting your ducks in a row, so to speak, then when you move into that next phase of finding a buyer or engaging a buyer, you're not taking 3 weeks in order to scrub your financials and to figure out what you want to present to them. Everything is ready to go. And I think, doing those types of things preparatory and doing them even as a house cleaning exercise, looking at your company. A lot of companies have said, I would never have thought of that particular thing in the valuation process. I'm going to look at that expense or look at that particular type of, income that I'm going to, that I'm working in to grow. I'm going to look into that a little bit more closely because you've brought that to light. So I think that that's really the goal, is to help companies prepare for sale, not necessarily, oh, I only do evaluation or I only go through the process if I'm going to sell my company. And I think that that's we always say, like, tell your staff that you're working with an outside consultant to look at your company, strategically, and to position it for its, highest level of success.
Yeah, I agree. Well, Mr. Fran Santangelo, great information. Thanks for joining us here today, and appreciate the good words on this, because there's a lot of activity, more than people realize out there. And I think there are a lot of people looking for advice that have never done this before. So thanks for joining and sharing your insights.
Thanks for having me, Nick. Have a great day.
Of course. All right, everyone. Brokerage valuation, hot topic in M&A work. If you want to learn more, I mentioned during the episode, don't FSBO your business. We bring in professionals to help sell houses, bring in a professional to help maybe sell your business or set it up. A couple of resources for you. You can connect directly with Fran, connect with us. We work with Fran. You can go to t360.com/connect, get directly involved with our team, and we can bring Fran in, help you along the way if you need some expert advice. So thanks again for joining us for Ask T3. Watch for the next episode. We are going to go on an inside track with NAR's CEO, and it will be a good conversation. So join us again, askt3.com. We'll see you next time.